Hey guys, Akil Stokes here. Welcome back to another episode of the Trading Coach Podcast, coming to you 3 times a week on your favorite podcasting app. Today is another video episode, and we are going to dive into the charts a little bit. So if you want to kind of follow along and see what we're doing there, make sure you check this out over on Spotify or over on YouTube, as that's where the video versions are available. Now, in today's episode, I'm going to share with you 7 technical trading rules from a legendary trader, a trading great, none other than Linda Bradford Raschke. Now, if that name sounds familiar, you may remember her from the new Market Wizards books, not the newest Market Wizard book, which is right here, by the way, but the new, literally the new Market Wizards book, as she was featured in there. She's also the author or co-author of one of my favorite books, which I'll share with you at the very end of this episode. More importantly, she was a female trader at a time where females were not supposed to be able to trade. And that quote comes from some old man back in the 1980s that said females can't do stuff that men can do, right? Not only did she prove that women can be a massive force in this industry and they can be successful, she's also proven that women can be much more successful than men. So she's a very good inspirational source, and again, one of my favorite traders from the technical side to learn from. So let's dive in. Actually, before we dive in, the stuff I'm supposed to say. Subscribe if you're new, that way you don't miss great content. Like, that way this video is in your algorithm and you don't miss great content. Either way, do those things and you won't miss great content. Now let's hop in. So let's start with trading rule number 1, which says buy the first pullback after the new high and sell the first rally after the new low. And this is actually one of my favorite trading setups to trade. We're going to hop into the charts to discuss this. Now, without getting into too much of Dow theory or Wyckoff cycles and stuff like that, understand that the market kind of flows like this. It goes sideways and consolidates, and then sometimes it goes into an uptrend, and then sometimes it consolidates, and then sometimes it continues in an uptrend or it goes in a downtrend. But pretty much the markets go through these periods of consolidation, directional movement, consolidation, directional movement. And what I personally like to look for is this. After we have this period of consolidation, at some point we are going to break out one way or the other. I don't know which way we're going to break out, which is going to be a rule we'll save for later in today, but I do know we're eventually going to break out, right? Contraction leads to expansion. If you just squeeze a spring long enough, right, the force that's generated eventually has to kind of disperse in one direction. So what I like to do is I like to bracket these setups. I like to draw a line at previous structure resistance, or I guess current structure resistance on the top, and I like to draw a line at current structure support on the bottom. And what I'll do is I will wait for a violation of one of those levels, meaning a break and close above or below one of these levels. And then my style of trading is a pullback trade. So I wait for the violation, which confirms that directional move. I wait for the pullback, which gives me a cheaper price to enter. And then I look to get involved on that next wave up. Now, if you're familiar with how we teach reading trends at Tier 1 trading, this is maybe a little bit confusing because we say that we need a 3-point move before we have an established trend. And yes, that is correct. We don't have a 3-point move in this case. But the point here is we are trying to jump on the newer trend or newer directional move as soon as possible before it is clearly recognized as a trend. That way we can take advantage of it once it is clearly recognized as a trend. So it's a little bit more aggressive, but like with anything, there are conservative ways to do it. And if you know what you're looking for, it's not as big and scary as if you don't know. So learn. I suppose with that being said, this would be the perfect time to shamelessly promote learning how to trade. If you want to learn how to trade, head over to www.tier1trading.com. We have coaches, we have courses, we have a community. It is by far the best place to learn how to trade. If you don't believe us, check out the 14-day trial, get on the platform, experience it for yourself, and make up your own mind. It's risk-free, so there's no auto bill or anything like that. You're just booted off after your 2 weeks. Now, number 2, I'm actually going to combine this with another one because they're very similar, is the best trading reversals occur in the morning, not the afternoon. A greater percentage of the day's range occurs in the first hour, much more than it was in the past, and thus it's become increasingly important to trade aggressively if there are early signs of a strong trend for the day. So what this means is that the bulk of the trading activity happens during the beginning of the day, and then it tends to fade out as the day goes on. And we see this both in the stock market and in the Forex market. In the stock market, obviously, the beginning sessions are much more important. There's more fundamental news that comes out. The afternoons, when the market is getting close to its close, people have that kind of food baby in them from eating too much at lunch, and it just kind of slows down. No one really wants to kind of show their hand before the close of the market. We see this in Forex as well. The two major sessions in the Forex market, even though it's 24/7, are going to be the London session, which is by far the most popular session, and the US session, with the dollar being the most popular pair. And the London session, at least my time, Eastern time, USA, starts at 2 a.m. in the morning, and the New York session ends, I guess it technically ends at 5 p.m., but the overlapping of that session, London and New York, ends at 12. There's actually a podcast we did on sessionality of trading, which I'll find and dig up and put in the description box below at some point, but go ahead and find that. But the point is, after a dullish Asian Japanese session where London and US are both asleep, it's like a brand new trading session in the morning once London wakes up, and then once New York wakes up and see what London's has done. So you get a massive amount of movement in really the first half of that trading day, and it tends to continue on throughout the rest of the day unless we have any type of high impact news coming out. So if you want to take advantage of like directional moves or quote unquote the most or best movement in the market, it's going to be during that London/New York session where you want to do it. The next one is the larger the market gaps, the greater the odds of a continuation in the trend. And we're not going to talk about gaps too much because I want to make this more Forex related than stock market related. We don't see as many gaps in the Forex market, but rather think about this as momentum. We had a conversation in my live trading room the other day on volume, right? Specifically volume spread analysis, where because there's no true number volume in Forex, how you want to really dissect it is by looking at volume in comparison to the size of the candlestick and in comparison to sizes of previous candlesticks and their volume, right? And pretty much if a candlestick, if we're thinking about a breakout where price action breaks a key level of structure and it looks like it's going to go on forever, we want to pay attention to what the volume and the momentum of the candle, the size of the candle, looks like. A breakout on high volume is a much better sign that the breakout is more likely to happen. A breakout on small volume is like a head scratcher, where it's like, something's tricky about this. Because again, if there is that much buying interest, for example, for a bullish breakout, we should see a big old bullish candle. If we see a lot of volume and it's a small, tiny, unconvincing candle, that's probably a warning sign that we're being tricked and this may be a fake out. So if you see big moves, I'm not necessarily talking about weird news moves where there's reactions and corrections and stuff like that. That's a different story. If you see big moves in the market, specifically on breakouts, it tends to be a sign that it's a legit breakout versus a fake break. Next up is going to say the previous day's high and low are two very important pivot points, for this was a definitive point where buyers and sellers came in the day before. Look for the markets to either test and reverse off these points or push through and show signs of continuation. Funny enough, a really old trading friend of mine, Cody, who's been working with us before we were Tier 1 trading, came back to the platform, right? He's a full-time trader, he's got kids, he's got a lot to do, so he doesn't really spend a lot of time on the platform, but he came back recently and was sharing some of his charts with the community and talked about how he's got these, not a new style of trading, the backbone of how he trades is the same, but he's added new tweaks to it. And one of those tweaks was looking at session ranges. And ranges are important, right? When we talk about the markets, and the markets are interesting from a technical perspective because trading charts are the same on every single time frame, right? If you looked at a daily chart and looked at a 5-minute chart and you covered up the time duration of it, you wouldn't know the difference, right? They go up, they go down, they go sideways. A candlestick looks the same on each one. However, the signal that an hourly chart gives you is more important than what a 5-minute chart gives you. A signal of what a 4-hour chart gives you, is more important than what an hourly chart gives you, right? The signal that a daily chart gives you is more important than anything under that. And when you're looking for like clear signals, more legit signals, the daily chart is going to be extremely important. And here's why. I want you to think about time you have to make a decision, right? If I came at you right now and said, hey, choose A or B, you have 5 seconds. 5, 4, 3, 2, 1. You're probably going to make an emotional decision. You're going to be B, right? You don't really know why you chose it. Maybe there's one thing that stood out and you chose it, but you didn't really have time to think about it. So you made a decision, you gave an answer, but you didn't really have time to think about that answer. So how legit is that answer? Now, put yourself back in that position where I said, hey, you got to choose A or B, and you have 24 hours to decide, right? Now you have a lot of time at your hand to do research, to do this, to do that, and really make a much more informed decision. We look at daily charts as being the same way. Because there's only one candle per day, there's a lot that goes into the day, right? There's kind of breaking down what happened the day before and getting a chance to really let it marinate and interpret it. There is the news of the day that came in that maybe was crazy at first, but then it was like, not that big of a deal. There's a lot of stuff for you to take in to kind of really take your time to understand and break down before making a final decision. So the close of those daily candles are going to be really important, and so are the ranges, right? The ranges are the highs and the lows, right? Those are the ceilings. There's a reason that we couldn't push past this level. There's a reason we couldn't push below this level. They're important for a reason. Therefore, when price comes to that level again, it's going to be a very important decision point. If you're familiar with our style of technical analysis, when we get to those decision points, now all we have to do is wait for the market to tell us what it wants to do, and there's usually a pretty good reaction from that. Speaking specifically from a technical perspective, if we hold, then I expect reversal. If we violate, meaning break and close beyond, then I expect continuation. That's the whole IPDE process that we say in each and every one of my YouTube videos. Piggybacking on that, the next one is going to be, and I lost count of what number I was on because I'm combining a few of these together, but we're going to call it 4, maybe? I don't know. The last hour of the time chart that you're on, whatever it may be, often tells the truth about how strong the trend truly is. Smart money shows their hand in the last hour, continuing to make positions in their favor. As long as the market is having consecutive strong closes, look for uptrends to continue. The uptrend is most likely to end when there is a morning rally first, followed by a weak close. So that kind of piggybacks on the importance of like the daily range, but I want to take out a portion of this and just talk about movement in the final hour, or rather movement in the towards the end of a session. Again, it doesn't matter whether you're on a 5-minute chart, an hourly chart, whatever like that. But if you pay attention to the price chart, right? By the end of the session, so if I'm on an hourly chart, by the end of each hour, you tend to see the candles move a little bit more than usual. That's because people are trying to position themselves. And again, going back on how each time frame is more important, you see this a lot at the end of the day, and from a bigger macro perspective, you see this massively at the end of months, at the end of quarters, and at the end of years, right? So these closes are very important. So if you pay attention to price at the end of these sessions, especially the important ones, it's going to give you a really good idea about how smart money feels and how smart money wants to position themselves now, and that's going to help you predict how they may want to position themselves for the future. Number 5, maybe, right? This is going to be a long one. I'm not going to break down the entire thing, but I do want to read you the full deal. There are 4 basic principles of price behavior which have held over time. Confidence that a type of price action is a true principle is what allows a trader to develop a systematic approach. The following 4 principles can be modeled and quantified and hold true for all time frames, all markets. The majority of patterns or systems that have a demonstrable edge are based on one of these 4 enduring principles of price behavior. Charles Dow, that was the whole Dow with everything we talked about earlier, was one of the first to touch on these in his writings. 1, a trend has a higher probability of continuation than reversal. 2, momentum precedes price. 3, trends end in a climax. And 4, the market alternates between range expansion and range contraction. Now I want to dive into each of these very briefly, because if I go too long, this will turn into like a 1-hour long podcast, and nobody wants that. But first and foremost, I think it's important to understand that price moves the same no matter what you're looking at, time frame, market, right? It moves the same, and it follows these main core principles. And as a market technician, a technical trader, if you can understand these principles, it gives you a much better ability to extract your edge in the market, right? there are two types of traders out there. There are traders who actually want to learn how to read the market. They want to learn how to read the market, understand the market, interpret the market. They look at the market a little bit differently. They see not just candlesticks that are red or green or whatever colors you have them, but they see a story that is unfolding. They see bodies and wicks, and these are rejections, and this is momentum, and these are spikes, and this is buying interest and selling interest, and these are battles. It's this weird place that we go to, but it makes us understand it, right? The price chart is nothing more than a visual representation of all of the market's participants and all of the actions that they have taken. So as I'm watching this, I'm watching you. That was weird. I'm not watching you. I'm watching that. I don't watch people. That's not what I do. Can't foot and mouth. But you guys get what I'm saying. I can understand human behavior patterns, and it helps me find an advantage. So that's one type of trader. Those are the traders that usually go on to succeed. The other type of trader that is just the one that's looking for something, where it's like, I don't understand how the market works. I just want to find a very specific pattern and look for it over and over again. Now, I'm not saying that type of trader can't be successful. They certainly can. But as we spoke about in the previous podcast, markets change over time, and the trader that can really understand and interpret the market, they're going to have that ability to adjust and adapt as the market changes over time. The one that can just find something and that's the only skill they have, well, hopefully that thing works. If it stops working, they're done. So the first one, a trend has a higher probability of continuation than reversal principle. And this is going to be certainly true in the stock market, right? 100% true in the stock market. Stock markets tend to be very directional. There is, it trends 70% of the time. It consolidates 30% of the time. Forex trading is a little bit different. Forex trading is the opposite. There's much more consolidation, not in every pair or every asset, but in the majority of them, meaning that we tend to consolidate 70% of the time and trend 30% of the time. And that's just because of the nature of the Forex there's no bullish or bearish. It's bullish for this versus bearish for that, bullish for, it's weird, right? But that's why we get that consolidative pattern. But the idea is that you need to understand the principle of your market. You need to understand the path of least resistance. Is my market that I'm trading more likely to do this or more likely to do that? Is my market that I'm trading more likely to do this or more likely to do that? We had a good conversation in our private Q&A session on Monday about, it was a trader who was working on a strategy. He's testing the strategy called the Jason Greystone trend continuation strategy. And the problem that he was having was that he was getting confused by micro trends and fractals, meaning that there is an underlying trend. Right? I'm going to go back to the chart, but I'll try to explain this out. There is an underlying trend in the market. So if it's a bullish trend, it has long extensions up and smaller pullbacks down, long extensions up and smaller pullbacks down. The thing is, each of these pullbacks, right, as you go down to a lower time frame, is going to be its own smaller bearish trend, right? And then within that smaller bearish trend, as you go to a lower time frame, is an even smaller bearish trend. And it's like Inception, where you keep going through a thing and then you get confused because you don't know if the top is still spinning or not, right? It's weird. And it gets traders all messed up. And we were speaking about this and talking about, one, how to understand the difference between what is the true trend and what is like the baby trend inside of it. But also touching on the fact that, hey, just because it's a baby trend, oh, you're so cute, right? We can still trade it. You just have to understand the underlying motion in the ocean. That's a weird one that probably means certain things to different people. But you got to understand the underlying move. So if we are in a if the macro trend is bearish and you are trading a baby micro bullish trend, yes, you can still trade that bullish, but you have to be more conservative, or you should be more conservative with your profit taking, because you know that you're only expecting a small move, because that small bullish trend is simply a pullback in the bigger bearish trend. However, if you're trading the bigger bearish trend, then you can afford to kind of shoot for bigger profit targets because you're now in line with the rhythm of the ocean. I'm having a bad time with words today. I haven't had my coffee yet. But hopefully that makes sense. Understanding the nature of the market that you are trading, and understanding that different markets trade differently. I said I was going to get really, really long, and I did already. So let's cut it down, Akil. Number 2, momentum precedes price. This is the understanding that everything is reactive in the market, right? All indicators lag, even the price chart, right? The candlesticks, which is the best indicator that we have, in my opinion, this also lags because a price chart doesn't get made until volume comes into the market and moves it. So not digging too deep into volume, but if you can see the clues of like high volume moves, like we spoke about with the breakouts earlier, you can make predictions on what is likely to happen next before it actually happens next. Number 3, trends end in climax. I want you to think about this like a star blowing up, right? There's a star named Betelgeuse, which should be blowing up within our lifetime if it hasn't blown up already. But the trick is that by the time that we see it's blown up, it means it would have blown up like a century ago. Space is cool, but in most things that blow up before they like get sucked back in and form like a black hole or whatever happens, you see this big bright spark. It's like boom, and then it's nothing, right? End of a fireworks show where all the fireworks go up in crescendo, and then it's done. Price is the same thing, right? At the end of a trend, and go ahead to check out your price chart, we see these kind of big last ditch efforts, like this last move to push it higher, and then it usually is rejected. You usually get like a long-tailed candle and it's like it's over, right? So if you can learn to spot those, right, high test candles, pin bars, stuff like that, specifically at the end of long-term trends, that's going to give you an edge on A, knowing when the trend is over, so you should not get involved, or B, knowing when the trend is over, so you can get involved in the opposite direction. Number 4, the market alternates between range expansion and contraction. We spoke about this earlier. Price only moves in 3 different ways, right? It goes up, down, and sideways. It tends to consolidate, then expand, consolidate, then expand. Boom. Just to touch on that note, when I'm teaching traders, something I do because I have the ability to make complicated stuff simple, I told them that, hey, like, in these courses, we're going to teach you all this cool stuff. We're going to teach you double tops, double bottoms, head and shoulders, trend continuations, blah, 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 right? But understand that whatever we teach you, ascending triangles, descending triangles, it all comes down to 3 principles because there's only 3 ways that you can trade. And I found that this helped me in not getting overwhelmed by the bunch of jargon and strategies that are out there, right? 1, the market can break out. So it is at a level. I have a price chart on. Why am I not using a price chart? Yeah, I have a level here that we're currently trading at on structure on the FTSE, and then we break out of it. Boom, that's one way. The second way is that we pull back. This would be used as a continuation trade. So after the breakout, we retrace, bang, and then we look for a pullback to hop on that next extension. That's called the pullback trade. So the breakout is the breakout trade. Waiting for the pullback and hopping on that is called the pullback trade. And then there's the reversal trade. So this is kind of what we're doing right now on the FTSE, where price action has come to a previous level of structure. And this, instead of breaking out of this level holds and we go the opposite direction. If you can understand that, breakout, boom, explode, pullback, wait for market to explode and then come back to cheaper price, or 3, reversal, right, where it comes to that level and it never explodes, it just fizzes out and goes the opposite way. If you can understand those 3 principles, you can really trade any way in the market because everything else falls under those 3 principles. And I've challenged traders for years. I've never gotten an answer. This is not a challenge to you, but I would love to hear it because I like hearing difference of opinions. Is there any other way to trade that doesn't fall into one of those 3 categories? Seriously, I'm not trying to be like, yeah, I'm smarter than you and that's the only 3 ways. Like, if there is, I would like to know because I'm generally curious about it. So leave that below if you have an answer for that. I would love to discuss and dig into it. I like to learn stuff too. Last one, the finale, and probably the most important one in the world. In the world of money, which is a world shaped by human behavior. Didn't I say that earlier? Yeah, see? Nobody has the foggiest notion of what will happen in the future. Mark that word, nobody. Thus, the successful trader does not base moves on what supposedly will happen, but reacts instead to what does happen. So 2 things I want to touch on this. 1, my pet peeve. I hate when people say or ask, will the market do this, or the market will do that, or it has to do this. And like, it's the trader nerd in me. It makes me so upset because when I hear it has to or it will, it makes it seem like we have some type of control over the market. We have no control over the market, so stop using those words. You could say it might, or I predict, or there's a good chance, but because that's working off probabilities and whatnot, but we never know, so stop saying that stuff because I will get angry and I will beat you with a bat. Hopefully I remember to insert the Lucille thing from Walking Dead. hey. That's not the quote. So although I butchered that quote, there is a quote that I say, and I hope I don't butcher it because it's my quote, about how I like to frame trading. I like to say I like to be predictive in my analysis, reactive in my execution. What that means is this. I want to look on the charts. I want to do all of my fancy analysis, and based on probabilities and edge, I want to predict what I think is likely to happen next. So if we go back to the chart that I'm looking at, right? Price action is at a previous level of structure. We are at a previous level of structure high here on the FTSE, right? We have so far held that high. We have not broken and closed above it. Let's say I am a bullish trend continuation trader, and I'm saying, hey, I think the FTSE is going to go bullish. So I may think that. I may have past knowledge and whatever I have in my chart that gives me that prediction, right? We've been in a bullish trend. Yay, I think that now, right? But the fact is, I still need to wait until I get some sort of confirmation. Just because I think it's going to do something doesn't mean it's necessarily going to do it. I want to think it may do something, and then I want to wait for it to give me a sign that it's more likely to do the thing that I think than not do the thing that I think. I think that made sense. And that is being predictive beforehand, understanding what I'm waiting for, and as soon as I get that signal, that thing that says, hey, Akil, come here. I'm about to do it, right? Then I want to jump in. So that's predictive in our analysis, reactive with our execution. Now, before we go, I promised you a book that I enjoy. It is over here in my thing of books, and it's going to be a book by Linda Raschke and Lawrence Connors called Street Smart. Now, this is a very interesting book because I am mainly a Forex trader. My background is in the stock market, however, so I do have a deep place for that in my heart. But this is a book that talks about a lot of classic stock market trading strategies. Now, it's important to understand, I mentioned this earlier, Forex market, stock market, two different markets. Strategies that work in the stock market won't necessarily work in the Forex market because, again, two different markets that do two different things. But as a trading nerd and someone who set out to be a classic chartist and a technical analyst, I love reading about kind of the history, right? Not just classic patterns because they still appear in the market and are highly profitable, but just all the different strategies that people have done. And I love this book because it takes you through a handful of classic strategies, many of which, so I've never used any of these verbatim, but many of which have sparked ideas, meaning I've taken different pieces of them and put them into the strategies that I now use. So if you're a technical nerd, it's a really good book. It's an easy read. I don't know what else to do. I'll show you inside. There's kind of cool charts. There's really easy explanations. It's not really nerdy if you're someone that likes not nerdy type of stuff. But it's certainly a cool book to have if you're a technical analyst and kind of learning more about your history of trading. Probably not a good idea to talk while my back is to the microphone, but I'm not a professional. I'm just a dude that got good at trading and now does a podcast. Speaking of the podcast, if you want to support this dude and his podcast, a few things you can do. 1, rate, review, show me how much you love me. That is great. 2, subscribe and like, put this in your algorithm so you can watch it more and I can get more comments and more cool ideas for the Trading Coach podcast. And 3, this one's not related, but if you ever want to learn how to trade, again, head over to www.tier1trading.com. It's an awesome community. You got some awesome dudes to learn from, and it's an awesome set of courses teaching you more in-depth details of much of the stuff that we spoke about today. So I appreciate your support. Keep it up. And until next time, plan your trade, trade your plan. Take care. Coffee time.